My name is Jack Arbor. I am going to be your instructor / professor. We're going to go through today Annuities 101. This truly is a 101 course. It's the very, very basics. So what exactly are we going to cover? First, we're going to understand the basics of annuities from a very broad standpoint. We're going to talk about liquidity features and contract guarantees, how annuities fit into the retirement planning picture, when are they suitable, when are they not. Fixed index annuities, very large seller in the industry today, so we're going to talk about those specifically. Taxation of annuities, how are they taxed, whether they're qualified or non-qualified. 9 important annuity answers in the back of the package of information that we all have. And then finally, I believe all of you should have an NAIC buyer's guide. Does everybody have this binder here? Okay, and everybody has a buyer's guide?
Yes.
Okay, so first up, the basics. Page 1. So this is an Annuity 101 course, so I really don't want to miss any details. Some of this stuff for a lot of you is going to be information that you already know. For some of us, it is not. But annuities as a whole can be broken down really into 2 categories. We have deferred contracts and we have immediate contracts. A deferred contract is one that you purchase with periodic premiums over a period of time. It is one where you are allowed to, after opening the contract, continuously add premium to the contract and take money out at different periodic intervals. An immediate annuity, often called a single premium immediate annuity or sometimes called a SPIA, is a program that is purchased with a single premium and the payments to the person who owns the contract begin immediately, usually right away, meaning day one. So deferred, you can add money over the course of time. A SPIA, single premium immediate annuity, those are ones where you put the money in and again, the payments begin day one. Flexible premium. These are only in deferred annuities. A flexible premium plan offers periodic payments, monthly, quarterly, semi-annually, or annual to accumulate the contract value. Single premium, we've covered that. Fixed index annuities. Today, these are a huge seller in the industry. These are annuities that, regarding the interest rate that you earn, is based on the performance of an index. We're going to talk about that more specifically. Multi-year guarantee annuities, often called MYGAs, is an annuity contract between the person who owns the contract and an insurance company, and it really says nothing more than for the next, say, 3 years or 5 years, the insurance company is going to pay a certain rate of interest. 3% for 5 years would be a very common MYGA in today's industry. And what that means is that for the next 5 years, the client who owns a contract is guaranteed to get a rate every year of 3%, never more, never less. Tax qualified. Who can tell me what tax qualified means? Correct. IRAs, 401ks, 403bs. They are granted tax favored status. They grow tax deferred. It does not mean that the money that comes out is tax free. It grows tax deferred. There is a difference. We'll cover the difference between tax deferred and tax free. Non-tax qualified means non-IRA, non-401k. They have different tax status. They establish what is called a cost basis. That is the amount of money that the client puts into the contract. That is the amount of money that has already had taxes paid on it. Any questions there? Section chapter 1.
On immediate, that has to come out within a year, right?
Yes, it does. Yeah, and again, with an immediate contract, they're usually starting the first week that the person owns the contract. Annuity liquidity features. Annuities typically have penalties associated with early withdrawals called surrender charges. Every annuity out there, whether it's a 5-year contract, a 10-year contract, or a 16-year contract, is going to have a surrender charge schedule. A surrender charge is a penalty that applies to the withdrawal that a person takes from the contract that is above and beyond what is known as the free withdrawal. So every annuity contract has usually a free withdrawal of, say, 5, 10, some are 15%, meaning they can take up to that percentage of the amount of money they invest in the contract without incurring what is called the surrender charge. But a surrender charge is a penalty to the client, and it is applicable to the money being only that of which is above and beyond the free withdrawal. Any questions there?
You said just the original money, or now money that's actually made money on that? Say the following year, you waited 2 years.
Okay,
Put
so
in 100,000. Is it you're getting just 10%? Right, you're getting 10,000.
right. So the question is what amount of money is the surrender charge applicable to? It is the amount of money above and beyond the free withdrawal. Let's just say, for example, that the free withdrawal is 10%. 10%, and this is an important question, 10% of what? Is it 10% of the originally paid premium, or is it 10% of the accumulation value? You may have a client who purchased a contract for, say, $100,000, and now it's worth $150,000. The answer to that question is different from company to company and product to product. Some companies, it's a 10% free withdrawal based on the amount of paid premium, the amount of money that was used to open the contract, and other companies have programs where it's based on the accumulation value at the time. So if it grew from 100 to 150 and it's a 10% withdrawal, it may be on 150,000. If it is based on the originally paid premium, it will be 10% of the original 100, so a $10,000 free withdrawal. Okay? Let's think about savings accounts for a second. What's the benefit of a savings account from a liquidity standpoint? You put the money in, you can take the money out any single time that you want. CDs, almost the exact same. They have not a surrender charge schedule, but they have a penalty feature. You put a set amount of money into a CD, let's just say that it's a 1-year CD. You can access that money if you would like to. You can take money out, but usually you would pay a penalty that is equal to 3 to 6 months of the interest that is earned. So if you have a $100,000 CD, and let's just say that it's paying 1%, which we all know in today's environment is being generous, that person is going to earn $1,000 per year. If they wanted to take out money from that CD prior to the maturity of the 1 year, they're going to pay a penalty that is equal to 3 months or maybe 6 months of interest. So $83.33 a month times 3 or 6 months, and that's what they're going to pay. The importance is to look at this fact here, 4th paragraph down. Thus, it is safety and potential to earn a high rate of interest that are important to a consumer. And here's the important part. It makes sense to compromise a bit of liquidity for a portion of their retirement savings. Why are we saying that? Because we know that in an annuity, we have a surrender charge schedule. However, we also know that annuities pay typically higher rates than a CD or a savings account. As we will hear later, when you're looking at liquidity, you're talking about rate of return and other factors, it's very rare that you're going to get everything that a person really wants in an investment in one basket while having all of the safety that is offered by some of the annuities that are available today. So let's consider an annuity with a 10-year surrender charge period. Does that mean the buyer can't touch any of their money during the next 10 years? Absolutely not. This is something that we see all the time. I've had, I would say, probably 10 consumers in the past year alone where you go through the surrender charge schedule, you explain they have a free 10% withdrawal, you go back for your second appointment, you ask them what they like, what they don't like, and one of the things they always say is, I don't like the fact that I don't have access to my money. They think that the 10-year surrender charge schedule means that for 10 years they can't access any of their money. And that is a very wide perception that the public has regarding annuities, that you put your money away and then it's locked up. When people find out that you have the ability to withdraw 10% per year, it's pretty good news, because 10% is a decent amount of whatever a person puts in, especially if we're talking about IRAs or 401ks or retirement money. When a person is 65 years old, how many people are going to withdraw 10% a year, every year, for the rest of their life? It's not going to happen. They're going to run out of money. So 10% is a fair amount. Because of the fact that a surrender charge provision exists in these annuities, it's important to note here, as it says in the last paragraph, that these are appropriate for only a portion of a person's retirement assets. You're not going to take a person who has, say, $250,000 in assets and put $250,000 into annuities. You need to make sure that they have their emergency funds, they have a fund for capital expenses, they have liquidity, and they also have diversification, and maybe a portion of this money is set into an annuity for the purposes of creating lifetime income, adding a layer of safety to their overall investment, and still having access to a decent rate of return.
Do you have a benchmark for that?
Yeah, is there a formula?
For what? For that, in terms of how much percentage generally that you target for investing in annuities?
It varies, and it varies widely, and the reason is because you may run into a client who has, say, $200,000, and you may run into a client who has $5 million. Okay? The client who has $5 million may not put, say, half, or half of $5 million. Let's say they're going to put $2.5 million into annuities. Probably not. They're usually a managed money client. However, if you run into a client that has $200,000 and that is all the money they have to their name, and they have concerns about market loss, and they have concerns about outliving their income, may you put $100,000 into an annuity to create that income? Yes, you may, but you have to do your fact finder, and you have to make sure that the $100,000 is enough for liquidity purposes, emergency expenses, their capital expenses, and that they're not going to be put into a position where, when withdrawing from the annuity, they may likely have to take enough money out to incur a surrender charge or a penalty. You want to avoid penalties if you can.
That's where suitability comes in?
Yeah, suitability is going to review that as well. I always tell a client, you should never put enough money into an annuity that you have that is going to cause you, statistically, a good chance of having a surrender charge on that money. You should never put that much money in where you have to wonder, am I going to have a surrender charge? And I talk about that when we're talking about surrender charges themselves. Because a lot of people say, hey, I don't want to have a penalty, and I say I completely agree, but if we do the planning properly, you should never have one. Because you should never put so much money in there to begin with that it's likely to happen. The question is if a person owns an annuity contract and in, say, years 1, 2, and 3, there is no free withdrawal taken. In subsequent years, can you take more than 10%? The answer to that question, again, is it depends on the company and it depends on the contract. There are some programs out there that have a very nice feature called a cumulative withdrawal, and the highest one that I know of in the industry is 20%. So if a full year goes by, contract date to contract date, that period of time goes by, and you did not take a withdrawal, you can take 20% the following year. If 3 years goes by, can you take 30% or 40%? The answer is usually no. I have never seen one of those. So those were the basics of the liquidity. Number 3 is state regulation and guarantee. Everybody here in this room is licensed. We all hold a license, correct? There are people who watch what we do. They make sure that what we are doing is right for the consumer. If you look at the second paragraph, it says, within the realm of market practices and regulation, regulators pay particular attention to unfair trade practices, including unfair sales practices such as false advertising, churning. What is churning? Rewriting cases simply for the purposes of generating a commission. Twisting. Twisting information, giving misleading facts. Disclosure, suitability, and supervision. We've talked about suitability a little bit. We'll talk about financial suitability here in about 10 minutes. Illustrations. They review illustrations to make sure that we are not showing clients projections that are completely unrealistic. Producer licensing, training, and consumer complaints. It says here, provisions of law designed to ensure that insurers operate in a manner that minimizes the possibility that they will be unable to meet their contract obligations, as well as provisions of law providing for regulatory oversight of insurers' solvency, and in the event that an insurer becomes insolvent, provisions of law as well as regulatory responses designed to ensure the contract holders receive all that they are contractually entitled to. So we hear a lot of people say, I have this CD and I'm getting a very low interest rate. However, I'm looking for something more, but I really, really like that FDIC insurance that I have at the bank. What do we have here? We have oversight that is going to make sure the client has something. Is it FDIC insurance? No. Is there FDIC insurance at a credit union? No. Is there FDIC insurance with securities? No, but they all have their own form of insurance. What do we have within the insurance business, the insurance industry? We have the State Guarantee Association. Every single state has a State Guarantee Association. Every insurance carrier in every state that's licensed to do business has to be a member of that association to be able to conduct business in that state. Here in Maine, we have insurance for life insurance. We have insurance for annuities. We have insurance for long-term care contracts to make sure that if a company does become insolvent, that person is still going to have their claims taken care of. Let's flip the page to page 4. This is interesting. I'd like to thank Tom Wright for putting this together. It says in 1983, the National Association of Life Insurance, of Life and Health Guarantee Association was created. People have asked this question all the time in appointments. From 1983 to 2009, how many companies became insolvent? It says 30 companies issuing life and or annuities nationally have gone through insolvency. So 30 of them since 1983. Let's look at what happened to them. 29 of those were liquidated 28 companies being sold to companies assuming 100% of their liabilities. So those liabilities were taken on by a new insurance company after Company A became insolvent. So 29 of those were liquidated, 28 were sold, 100% of their liabilities were covered, and of those, 100% of the claims were covered. One returned to solvency 4 years following the initiation of the rehabilitation. In 2009, the NAIC, which is the National Association of Insurance Carriers, adopted and revised the Guarantee Association model that increased the protection from $100,000 to $250,000. So FDIC insurance is also $250,000. The state guarantee is also $250,000. For more information, you can go to nolhga.org, and there is information there regarding the $250,000 amount and the amounts for life insurance and for long-term care. Questions?
So if you have more than one policy, then one's 250, another's 250, both of those are guaranteed?
So the exact wording is you have $250,000 currently of coverage per owner per member company. So if you were to own $500,000 at company A, only $250,000 of that is going to be covered. If you have $250,000 at company A, $250,000 at company B, the full $250,000 is covered through each of those carriers. So it's per owner of each contract at each separate company. Any other questions? So the question is can you have two contracts at one carrier, each be $250 and be covered to the state guarantee? The answer is no. It's $250 at each company per owner. It's based on your Social Security number. Okay.
So why would a client want to invest more than $250 then?
Number of reasons. They may say, I have $1 million and I want to protect $500,000. If they want to protect it, where are they going to put it? CD, a money market, then they're getting 0.25%. So maybe they want to invest more than $250,000. If the client is completely uncomfortable with how the state guarantee works and they're not comfortable having just $250,000, the answer is simple. Go to more than one company.
Jack, is that only for the state of Maine or is that a national?
Every state.
Every state is 250?
Every state is not 250, but every state has a guarantee association. As far as I know right now, every state is between 250 and 500. Okay. I would be expecting Maine to go to at least 300 within the next couple of years. Yeah. Basics, number 4, we have some resources here in terms of further information on fixed annuities as well as what we just mentioned with the state guarantee. So NAFA.com, this is the National Association for Fixed Annuities, fixedannuityfacts.org, indexed annuities, insights.org, and Annuity Ed, annuityed.org. This is a Society for Annuity Facts and Education. Okay, Chapter 1. Retirement today. What is the first thing that we notice when we look at this box? We don't even know what it is, but we see a bunch of numbers, and we see that we have a breakdown of retirees today in terms of where their income is coming from. A recent survey by FINRA Investors Education Foundation found that these are the major sources of income for retirees today. Social Security. The percentage of retirees who use this source of income, 81% use Social Security. It's a huge number. And it's also percentage-wise a very large number in terms of the total household income that a person brings in. Pension plans, 63%. 63% of people are depending on their pension. Withdrawals from savings, 26%. Dividends or interest savings, 23%. And income from employment, 17%. What is the challenge right now with Social Security in the big picture? Solvency, what we just talked about. 2033. If no changes are made, it is on track to become insolvent in 2033. How about pension plans? What's going on with pension plans?
Going away.
They're going away. We don't see as many employers offering a pension plan to their employees. So when we're talking about retiring in the 21st century, it's a lot different than our parents and grandparents who had the reliability of Social Security for their lifetime, that had a pension offered by their employer that says, hey, when you retire after your 30 or 40 years of service, you're guaranteed to have this income every single month for the rest of your life. So people are looking for these guarantees. It is clear to have a financially secure retirement, today's workers are going to need to save more on their own than retirees did, say, 30 years ago. So where are they going to put this money? What is one of the largest benefits of a defined benefit plan, a form of a pension? The name is telling you the answer. It's a defined benefit. You know exactly what you're going to receive. Annuities, fixed annuities, fixed index annuities, variable annuities, they're often used for these defined benefit plans. Why? Because as a defined benefit plan is designed, who's on the hook for making the payments? The employer. The defined benefit. The employer says you are going to receive X number of dollars per month for the rest of your life. What happens when the market goes from here to here and there's only this much money in the employer-sponsored plan to pay out all those monthly allotments? There's a challenge for the employer within the defined benefit plan. We might end up seeing something, in this case, go to the PBGC, the Pension Benefit Guaranty Corporation, because that pension plan may become insolvent. So plans today that are looking to create guaranteed lifetime income through a defined benefit plan are looking where? To annuities. And what are they doing? They're guaranteeing the payments and they're taking the risk off their own plate and they're putting it into the lap of the insurance company. Okay? So these are not things, financial instruments that are being just used by individuals or being used by governments, and they're being used by corporations in order to ensure that the payments they are telling their employees they're going to have are going to be there. Questions?
Do you target businesses for annuities?
Business owners, yes. The question was, do we target businesses for annuity options? The answer is yes, business owners. Not so much to their employees. Brian Heath works in the worksite department, and if we run into an employee who is leaving or is a new employee and has an old 401k plan at their previous employer, will we talk to them about that? Yes, we will. Buyer motives. Why do people buy annuities? I say it really comes down to 3 words. First one is safety, second one is growth, and the third one is control. Safety. When we say safety, what do we mean? We mean safety from market loss. We are looking at 2000, 2001, 2002, the market lost 43%. October of 07, March to 09, S&P lost 57%. Retirees who are 65 years old, just about to retire, and see their account balance go from wherever it was to about half, are not retiring in the exact same way that they were planning. So safety. By contract, a fixed annuity guarantees that your principal is protected and that you can get it back again as long as you avoid any penalties for early withdrawal. Number 2, as discussed previously, even if your insurance company fails, the value of your annuity up to $100,000 or now $250 is guaranteed by your state insurance guarantee fund. So there's 2 ways that we have safety. The third one is if you have a problem with the insurance company that issued your annuity and you want to get a regulator involved, no matter where that insurance company is located, the regulator is located in your home state. Okay. Growth potential. Why do we invest money? To grow. Okay. One thing I want to make sure that you all understand is that I just use the word invest. When talking to clients, we cannot talk about annuities as investments if we're talking about fixed or fixed indexed annuities because they are insurance contracts. They are not an investment. They are not a mutual fund. It's not a direct investment in a stock. It is an insurance contract. But we do this because we are looking to earn a certain rate of return, usually again higher than CDs or money markets, and we're looking to do it in a safe way. Tax advantages. What are the tax advantages? Somebody tell me what the tax advantage is of an annuity. Tax deferred. What does tax deferred mean?
Pay tax later.
Means you pay taxes later. You pay taxes only when you take money out of the account, only when you withdraw. And you're going to pay taxes at what rate? How are annuity distributions taxed? Whether it's an IRA as ordinary income. That's correct. All money that comes out of an annuity, whether it's an IRA, money from a 401k that you've rolled over, or a non-qualified annuity, if it's in a non-qualified, you're only taxed on the gain. If it's a qualified plan, you're taxed on all of it, but it's always taxed as ordinary income.
What if the state doesn't have an income tax?
It's still taxed at the federal rate, but you're not going to have state tax. Yeah.
I've heard in some cases there's a first in, last out
Yes.
on taxes,
Yes,
and I'm
yes.
not sure which annuities that applies to.
Okay. So the question is what does first in, first out, or in the annuity sense, LIFO, last in, first out. So last in, first out is I think what you were referring to. So within a non-qualified contract, again, if a person invests, say, $100,000, they're going to establish what is called their cost basis. In a non-qualified contract, the money that you put into the contract that you've already paid taxes on is referred to as your cost basis. That money you will never pay taxes on again. However, we're talking about growth potential right now, and let's say that 100,000 grows from 100,000 to 110,000. When we take that $10,000 out, it was the last money that went into the contract. We put in our 100, and then the 10,000 of gain went in. That was the growth. That was the last money to go in. That is the first money to come out. Last in, first out. So that $10,000 is now going to be taxed, and it's taxable again at ordinary income tax rates. Okay? Questions there?
So you said that was for non-qualified, but for qualified accounts?
For a qualified account, all of the money that comes out of the contract is going to be taxable. The only exception to that rule is a Roth IRA. A Roth IRA is considered a qualified plan. However, it is not taxed as a IRA or a 401k. The distributions are 100% tax-free. Lifetime income. How important is lifetime income? We do workshops across the state. We do them across the country. One of the number one concerns of retirees is outliving their money. So with these annuities, whether it's through the form of annuitization, which is kind of a thing of the past, or whether it's through using an income rider, what we can do with these annuities is we can create an income stream that is guaranteed to not be outlived. What that means is that if a client invests a certain amount of money, it's growing, it's earning interest, they start taking payments from it, whether it's immediate or deferred, they start taking payments at some point. And even if at some point in the future they've used all the money they put in, all the money that are earned in interest, and the account balance is now zero, they're going to continue to get the amount of money every single month or every year that was guaranteed to them at inception, and that is going to continue for as long as they live, no matter what. So lifetime income, even when the account balance reaches zero. What happens in the process of annuitization? When we annuitize a contract, say for $100,000, client calls up the company, say 3 days later, and says, what's my account balance? What is it? Zero. Why? Because we have exchanged a certain amount of premium for one thing, a stream of payments. So your account balance in an annuitized contract is zero immediately. After annuitization, the amount of money that you put in is only coming back to you in the form of income. There is no cash balance. But the payments are guaranteed again for life or for a certain period of time. Liquidity. Most people recognize that liquidity, and here it is, I was mentioning this earlier. Most people recognize that liquidity, safety, and growth do not coexist very well. For example, with a checking account, you get excellent safety, you have total liquidity, you can access the money anytime that you want, but most checking accounts are paying a very low rate of interest. You may go and you may find that something has excellent growth, like a mutual fund or a stock for a certain period of time. However, we do not have what? We don't have the safety. Do we have the liquidity? Yes, we do. So where can we get all of these things? To be honest with you, I don't know of a place. There is not a place that has all three. There's no place that has 100% liquidity at any time that you want it, while being 100% safe, while having excellent access to growth. You're going to give up a little bit in one of these three areas, regardless of what type of program you choose. So, for the right client who is willing to give up a little bit of liquidity in the form of this surrender charge schedule in order to get a higher rate of return, still have some liquidity, but have that level of safety and that peace of mind knowing their money can't go anywhere, it may be something to consider. Again, it's not for everybody. Estate advantages. What is the largest advantage of an insurance contract? Not just annuities, but insurance contracts in general when it comes to estate advantages. The death benefit, specifically, if we list beneficiaries as individuals on the contract, the money in the contract is going to go directly to whoever we list as beneficiaries. It's not going to go through probate. It's not going to become public record. It's not going to be potentially contested in probate court by somebody who says that whatever's happening in the will is unfair. None of that's going to happen. So you're going to maintain the privacy, and you're going to speed up the process at which the money that you had in your contract at death gets into the hands and the possession and ownership of your beneficiary. All insurance contracts give the right to list a beneficiary. I would tell you, especially with IRAs, you want to make sure that you list beneficiaries as individuals and not the estate. And we're going to talk about why in just a few minutes. Any questions about avoiding probate in the estate advantages? Chapter 3, where annuities fit. So, it depends, right? It depends on your client. It depends who you're working with. Again, an annuity is not for everybody. But if we look at things like CDs at the bank, what is the benefit of a CD at the bank? We have the safety. What is the downside? No growth. So, do we ever run into people who are looking for some safety but looking for more growth? Absolutely, every single day. So there's one place. Fixed annuities. When can we use fixed annuities? Just your straight traditional fixed 5-year, 3%. When will those come into play?
When you want to, when somebody has a CD.
If you're looking for a very close apples to apples match, you're looking for all the same safety, but you're looking for a guaranteed rate. Maybe a person doesn't want a fixed index annuity and not know exactly what they're going to receive in year 2, year 3, year 4. They understand they could potentially make more than the MIGA, but they don't know. And for them, that's not good enough. And they say, hey, I just want the guaranteed rate of 3%. That way, every night when I go to bed, I know exactly what my money is doing. No question about it. Yes, tax deferred. Good point. So if we're talking about a non-qualified account, first of all, if we talk about qualified accounts, there's no benefit to buying if you own an IRA. There's no benefit to buying from a tax standpoint an annuity because the IRA is already tax deferred. However, if you have some money in a CD and you make, again, 1%, you make $1,000, do you get to keep that $1,000? No, you're going to pay taxes on the $1,000. If it was within an annuity and the annuity also earned 1%, that full $1,000 of interest will stay in the account and also earn interest the following year. So you have the power of compounding interest. Fixed index annuities. Fixed index annuities are a special type of annuity. They evolved. I believe the first one was sold February 2nd, 1995. They've become extremely popular due to the fact that, number one, they offer all the safety that a CD does in terms of no market risk. They offer the same safety as a fixed annuity. However, they give the person who owns the contract the ability to participate in the upside of the market. They don't participate in, as many of you may know, all of the upside of the market, but are they more competitive than your traditional fixed annuities in terms of the interest rate they earn on average? Yes, they are. And do they have liquidity similar to a fixed annuity? Yes, they do. Mutual funds. You may run into a client who says, I have $250,000 invested, it's all in mutual funds. Maybe it has been doing pretty well, maybe it has not. Maybe they're 65 years old now and maybe they saw what happened in 2008 and they went from the 500 down to the 250 and it took them till 2014 to get back to their 500 grand. They don't have the time anymore to wait, where if that was to happen again, they don't have the time to wait to be 70 years old and have their 500 get back to 500. So people who have money, this whole topic here of mutual funds is really talking about variable money. Mutual funds, stocks, exchange traded funds. If they're looking to take money out of the market, protect a piece of it, and still have access to competitive rates of return, an annuity may be something to consider. Why do people buy immediate annuities? First of all, let's go back. Refresher, little quiz question. What is an immediate annuity? Stream of income right away. From a single premium. Article in the Wall Street Journal, February 2000 said, best, retirement is a great financial riddle. Think of all the uncertainties. You don't know how long you're going to live. You don't know what investment returns are that you will earn. You only have a limited sum of money, and now there are no second chances. What are you going to do? It's a good riddle, right? What do we need? We need income. There's a great book out right now, Money, Master the Game by Tony Robbins. He does financial seminars all over the world. He asks people, what do we want out of an investment? They say, I want growth, I want rate of return, I want liquidity, I want diversification, I want access to my advisor, I want safety. But guess what? The number one thing is that people barely ever say. Income. Income. And that's why we're doing this. You need to have income. It doesn't matter how well diversified you are or how much money you have. At some point, you're going to start drawing from that. You need income. And we're all living longer, so we need the money to last as long as we do. When you purchase a contract, you and the carrier will agree upon how payments are going to be made. They're going to make an agreement with you, and they will say that it's going to be either monthly, annually, or some other frequency. You're going to decide. You're going to continue for a certain number of years. How long is it going to pay you? Is it going to pay you for 5 years guaranteed with a life option? Is it going to pay you for 10 years or 20 years, or is it a life only? In a life only contract, if you say, Mr. Insurance Company, here's $100,000, I want to start my payments today, and I want them payable only for life, you're going to receive from the insurance company the highest payout they're offering for that $100,000, but what's the risk? If you die tomorrow, there's no more cash coming to you because, number one, you're not here, and number two, it's not going to any beneficiary. It was life only. Okay? These are annuitization options. Another option, another example would be a 20-year period certain with a life option. That means it's going to pay you for as long as you live, as long as you're here, it's going to pay, but it's also going to pay for a minimum of 20 years. So if you have this option and you pass away in year, say, 15, and you list beneficiaries on the contract, they're going to receive, when you pass away, the next 5 years of payments. So that way you know that at least what you put in, maybe a little bit of interest, is going to go to your beneficiaries. Chris?
Now, if an annuity contract lists the annuitization options and it says 20-year period certain, but it doesn't say life 20-year period certain, is it the same?
It's not. No, not every period certain has the life rider on it or the life option. If you choose a 20-year payout, you can choose just a strict and straight 20-year payout. After that, it's done, even if you are still alive. Yep. I can tell you most of the ones that I've seen that are 10, 15, 20-year payout, most do come with a life option rider. But do they exist where it's just a flat 20 years? Yes, they do. So the question is, which one gives the highest payout? That is what I mentioned first. It's the life-only option.
And then the next one, between the two you just said.
Oh, okay. So then you have your 10-year, you have your 15-year, and you have your 20-year. What do we think? The shorter the number of years.
So what about with that life option though? You have the 20 years certain life option. Is a 20-year certain payout greater than a 20 years certain life with a life option?
The one with a life option is going to have a lower payout. Yeah, so the question is how does an insurance company decide what they're going to pay? It's based on actuarial tables. So how long is the person expected to live? How old are they? The time that they purchased the contract? How much money are they putting in? And which option are they choosing? Life only, 20 years, 20-year with life. There's probably 4 or 5 really important criteria that every insurance company will look at as a basis to start, and then they have each individually their own pricing model. If somebody says today, I want to buy a contract for $100,000, I want to put the money into an immediate annuity, I want a 20-year option with the life, they know they're going to pay 20 years minimum at a certain rate. They know that if the client passes away before that 20 years, that the other remaining years are going to go to a beneficiary. So they could say for sure, within the next 20 years, we're going to pay at least X percent on a $100,000 investment, which tells us immediately that there is a built-in internal rate of return. So the question is what is the rate that the insurance company is willing to pay? And as we know right now, with interest rates very low, you may see the average rate insurance company being around 2% to determine the rate they're paying per month on this 20-year payout. So the question is do you know how much money you're going to receive per month?
If I put $250,000 into a fixed indexed annuity and I have a 20-year certain, Am I gonna see a 20-year table that starts paying me?
Okay, so two things. First of all, within a fixed indexed annuity, most people today are not annuitizing the contract and using one of these life or life with 20-year certains because of the fact that we have riders today that will give people access to the guaranteed income, but also access to the principal. Remember, when you annuitize, you're giving up all access to your money. But when you buy, say, a fixed index annuity with a rider, or you buy one of these single premium immediate annuities that has been annuitized, do you know for sure exactly what your payment is going to be every single year for the duration of the time that you select? Absolutely, to the penny. That is the beauty of the design. A person says, this is what I have, here is what I need per month, and I need it on a guaranteed basis. So when we're talking about lifetime income, lifetime is referring to the guarantee, meaning as long as you're here, we're going to pay you, or for 20 years, here's what we as a company are guaranteeing for payments. Going back to the very beginning of today, the one thing I should have said in the very beginning is that an annuity contract in general is an insurance contract between you and an insurance carrier that says, in return for the premium that I'm paying, you are going to take my money, you are going to invest it in a way where I earn some interest based on the type of annuity that I buy, whether it's fixed variable or fixed index, and then at some point, whether it's right away or whether it's at some date in the future, you are going to start paying me a stream of payments. And if you have this guarantee or you have one of these riders, you do know exactly what that amount is going to be.
So can it change based on how the market does?
So within a fixed index annuity, some programs offer what is called increasing income. Not all of them do. I can tell you this, out of the hundreds of companies that are A-rated, there are very few who offer increasing income. Is there any chance of the income ever decreasing once it starts? No, there's not. Is there a chance for it to increase? Yes, there is, and it's usually based on the performance of an index. So as an example, if you're making $1,000 a month from your annuity in the form of the payment, and next year the market goes up 5%, you may have your payment next year be $1,050 per month. And then the following year the market crashes and loses 30%, your payment in year two is still going to be $1,050 per month. It's not going to revert back to what it was before. At the end of the day, we're looking to do what? We're looking to create income, we're looking to have it guaranteed, we're looking to have it start right away and have no question moving forward about what we're going to receive. Page 11, I'm going to read this out loud because it sums everything up that I just said. Because of their simplicity, immediate annuities from various carriers are easily compared. Once the buyer decides upon the type of payout desired, the decision of which carrier to choose typically rests upon who offers the best price or payout and financial strength of the carrier. Since the payment guarantee is supplied by the issuing carrier, the financial strength of the issuing carrier is an important consideration in the purchase of a single premium immediate annuity. So when you give your 100 grand to some company, you have to ask, what am I going to get paid and what is the strength of that company? Because you need that payment for life. And if you're comparing company A through Z, company A might offer $550 a month, company B might be $530, $500, $470, $410. You want to look at the highest payouts and make sure that number two, that the carrier you're selecting or the carrier you're advising your client to consider is one that has financial strength. And remember the $250,000 limits, so that in the event that even the guy who looks too big to fail does fail and becomes insolvent, the money is protected. So the question was, can you take an amount of money and decide that you want your payout to be 5 years, a shorter term duration? The answer is yes, you can. And Ruth, the way that you explained in terms of a person, we call it laddering. We ladder investments so that, say they buy it today, it's designed for a payout for the next 5 years, and in 5 years from now, something else is going to kick in that they've also set up today. So that 5-year payout stops, and then investment number two kicks in, the second investment number one stops. It's called laddering. Good point. FIA key features, reasons to consider a fixed index annuity. There are 5 very good reasons to consider an FIA as a component of a retirement income plan. An insurance carrier is able to provide each of these 5 advantages as long as the buyer is able to make a time commitment to the carrier. So what are they? Number 1, safety from market losses. How do we protect money from market losses? It's in a fixed contract. Fixed contracts, number 1, guarantee principal, and they also offer a guaranteed minimum interest rate. Every single fixed contract does that. Growth potential. Second reason to consider these is because of the growth. It's higher than your 1-year CD, your 2-year CD, your 3-year CD, and they're usually averaging rates that are better than your typical MYGA. Tax advantages, especially if you're looking at a non-qualified account. You have the power of tax deferral. Income guarantees. You can get these also within a single premium immediate annuity, but again, in those you're annuitizing. Within the FIA, you can get the income guarantee without annuitizing the contract. What is the number one benefit to that? If you have not annuitized the contract, you're still getting the guaranteed income, but we have what?
Cash value.
We have cash value. We have access to cash. I say all the time, annuitization in most situations is a thing of the past. Why would we want to give up all access to our investment of $100,000 when that $100,000 can now pay us our guaranteed lifetime income and have access to it in the event that we really need it? That didn't exist, those riders, 20 years ago. They weren't available. The foundation upon which these advantages are provided is a time commitment during which you will have limited liquidity. We've already spoken about this, the surrender charge schedule. Most common surrender charge schedule is what?
10 years.
10 years. What else is important when we're looking at surrender charge schedules, other than just the number of years?
Percentage.
The percentage. What is the actual percentage penalty that a client is going to pay? We see some that start at 20% in year one. We see some that start at 10% in year one. So you also have to consider what is the percentage that the client is going to pay on the amount of money they take out above and beyond the free withdrawal, which again is where the surrender charge becomes applicable, and ask, is it 20%, is it 10%, is it 9%, is it 8%? Because that matters as well. So safety from market losses. From the premiums paid to an insurance company for an FIA, they must set aside a percentage of that money in the reserves that is included as very safe assets. This money is not invested in the market. They're buying bonds immediately. They're buying option contracts so that you, as the contract owner, can participate in the upside of the market. By contract, FIAs guarantee that your principal is protected and that it will be available upon surrender. What else is protected? The interest that the contract has made. If you invest $100,000, you're one that makes 5%. On your anniversary date, that interest locks in. It's now worth $105,000. Next year, the market loses 30%. What's our contract value at the end of year two? $105,000. So it's protecting your principal. And we say it protects your principal, which means that new money, because on your anniversary date within the FIA, the fixed index annuity, that interest truly becomes your new principal. Okay? If the buyer has a problem again with the carrier, they can always go to the regulators. The regulators are always located within the state. Growth potential. We all see this chart here. Has anybody not seen a chart like this before? Okay, we've all seen it. What does it show? It shows the power, the effectiveness, and the reason why people buy FIAs. It shows the safety from the market. States here, in a year that the index increases in value, they credit an amount of interest to the annuity contract based on the market index increase. The amount of gain that the client receives is going to be based on either a cap, a participation rate, a spread, something that dictates what portion of the market the index increase is going to do for the client, the person who owns the contract. In a year that the index decreases in value, they hold their value. That was my example. If it goes from 100 to 105, locks in at 105 on the anniversary date, and the following year the market loses 30%, we're still going to have 105,000 in that contract. So what we see here in this chart, if we look at the first 3 years, 2000, 2001, and 2002, what did the market do during those years? Anybody know exactly? Negative 43%. From 2000 to 2001 to 2002. Planes hit the towers, $14 trillion was lost in retirement accounts. What do we see happen on the red line, which is the S&P 500? We see the nosedive. We see the 43% loss. What happens in the FIA? Flat. Zero is your hero, they say. Right? You don't make anything, you don't lose anything. So it stays flat. But what's the advantage? What happens after we see a 43% loss in the market?
It's gonna go up.
Big rebound. Happens all the time. Average return after a loss like that is 29%. So now the market shoots up. So we see the market start to shoot up. If you look at the graph with the FIA, it starts to do the exact same thing, but the line is not as steep. Why is that?
7% cap.
Because we're not making as much as the market. We have, again, either a spread, a cap, or a participation rate, as we saw on the previous page. So the good part is, however, is that we are not growing from this spot down here. We're growing from where we left off, which was our original investment of 100 grand. So we have no hole, as I say, to dig ourselves out of. We're starting at point A, reference point 1. Tax advantages. Again, this is a little bit redundant, but tax advantages. What are the tax advantages of annuities? Again, there is no tax advantage for a qualified account, an IRA, a 401k, a 403b, any money that's rolled into an annuity, say within somebody's IRA, it's already growing tax deferred. You would not roll money from a qualified plan into an annuity because of the tax advantages. They're already there. But in a non-qualified account, again, this is our example of the CD, you put $100,000 in, you make 1%, it's $1,000 in interest, but you don't keep all of it because it's taxed, because a CD is a non-tax deferred account. The annuity is a tax deferred account. So the $1,000, you are not going to pay taxes on that $1,000 until you decide that you're going to take it out, at which point we're going to pay taxes in what fashion?
Ordinary.
LIFO. That's right, last in, first out. Steiner,
I just
question?
wanted to be sure that some people understood that. When you said that you wouldn't roll it from a tax qualified account into an annuity because of the tax, you would do it, but the tax benefit isn't the reason.
Right, no,
Correct. I just want to make sure that that was clear.
Income guarantees. Two ways. Annuitization, we've already covered that. And the income rider. Again, what are the major differences between annuitizing a contract and receiving the same amount of income on a guaranteed basis through the form of an income rider? What's the major difference?
Cash value.
Cash value. What are some other ones? Riders cost money.
Access to principal.
Access to principal. How about this one? From an estate planning perspective, when you pass away, would you like to have, number one, guaranteed income from day one? Know for a fact that if you need to access the money, it's there. And number three, if you pass away, your beneficiaries are not stuck to receiving the next 5 or 10 years of payments, but they have access to a lump sum.
Right.
So that's another difference. They have access to the lump sum. Again, it's an insurance contract, so it's going to, if you list your beneficiaries as individuals, it will avoid probate. It therefore becomes a private matter and not one of public record, and it goes very quickly to whoever you list as beneficiaries. The question is if you pass an annuity to a beneficiary, is the money taxable? The answer to that question is, well, is it qualified money or is it non-qualified money? Are we passing to our beneficiary an IRA, or are we passing to them a non-qualified account? If it's a non-qualified account, then again, they are going to have taxability within the account, but only to the extent of gain, only on the amount above and beyond the original investment. If it's an IRA, as we learned from Rick Abendanza earlier, we're going to need to start taking, if we're not a spouse, if it's an inherited IRA, we're going to need to start taking required minimum distributions or all of the money within 5 years. And again, the exception to that rule is the Roth.
Here's my question. So the beneficiary, when you name a beneficiary with an FIA, you're actually passing on the contract and not the money? Or is it either?
When a person, number one, when a person passes away, the beneficiaries have a choice. They can say, I want to stay at company ABC, and I want to keep that same exact contract and go by those provisions. At that point, all surrender charge schedules disappear. There is no surrender charge schedule for an inherited contract. The beneficiary could say, I want to take the money from this contract, if it's an IRA, and roll it over somewhere else, or do a direct transfer. If it's a non-qualified annuity and the person wants to take all of the money out, they can do that, but they're not rolling it over. They're not putting it through what is called a 1035 exchange. So all of the money will be taxable to the extent of gain. So it depends on the type of contract. The question again is the money as a beneficiary taxable if you take all of it? Again, depends on, is it qualified? Is it non-qualified? If it is non-qualified, is there a gain in the contract? If it's a qualified contract, an IRA or something of that nature, it's all taxable. Okay. As you see here at the bottom of page 14, beneficiary planning advantages, it really boils down to two things. It's the speed, meaning if you list an individual as a beneficiary, it goes directly to them. It is not going to get caught up in probate, which although here in Maine is actually a pretty timely manner. It's really not that bad. And another advantage is the privacy. Probate is a public court process, and it does get recorded. So if you want your assets to go to your beneficiaries and you don't want the whole world to know about it, list your beneficiary as an individual, and it will go directly to them and bypass probate. Foundation, a time commitment. As we all know, most people recognize that liquidity, safety, and growth do not coexist very well. So again, going back to the surrender charge schedule, we have to realize that we're making a time commitment if we're either buying an annuity or there's a time commitment that we're asking our client to make, and that they need to understand when they're buying an annuity and that they do have access to their principal and to, in some circumstances, the interest that it's made. But they need to understand that it's at a certain amount per year, say 10%. And it's going to be 10% per year without a penalty for a certain period of time, whether it be 5 years, 7 years, 10 years, and in some cases even up to 16. So we need to understand how that surrender charge schedule works, how long it is, and what the percentage of the penalty is above and beyond the free withdrawal if they decide to take out more than that amount.
Chair, I have a question.
Sure.
In regards to the estate, what would be the advantage of somebody actually putting the beneficiary as the estate rather than an individual? I mean, obviously you told us what the advantage is to do it as an individual. Why would somebody actually then put it to the estate so they have to go through probate? Why would they do that? What's the advantage?
Is there a huge advantage? I would say I don't really think there is an advantage. You may have somebody who has a will, and maybe they spent great time with an attorney designing something within their will. Maybe they want to have this payable to a trust. That would also be different than what you're asking. But what is the benefit of it going to their estate? I don't really know. There really isn't. I mean, it's going to become public record. It's going to bypass probate. The only time somebody might do that is if they don't know who they want to pass the money to. However, they've designated certain things to happen within their will. But at the exact same time, even to that extent, if a person has a will and they want the money to go according to their will, they can just put whatever it says in their will on the primary beneficiary and contingent beneficiary line. You know, say they want to give the money to charity ABC, and that's in their will. Well, if they say that this $100,000 annuity is going to go to my church, it's not going to even go to probate. They can just put that right on the application for the annuity, and that will override whatever it says in the will. It's non-contestable. So I guess the direct answer, Rick, is I really don't know what the benefit would be.
Okay. So you're just guiding them then?
Yeah.
Say, look, yeah, designated beneficiary. Because if you don't, this is what's going to happen.
Correct.
Got it.
Make sure you do your homework regarding suitability. Make sure that they do have, again, emergency funds, capital expense funds. They have other liquidity than the money that you're putting in here. It says here, therefore, only use an annuity as a part of an overall plan where the buyer has other accounts which have no surrender penalties to ensure the short-term liquidity is available. Proper suitability standards require that a buyer has sufficient funds for that purpose in other accounts such as checkings, savings, and money market accounts. So you want to make sure that in doing your fact finders that you find out what else they have. You don't want to, again, be the reason why they're put into a position where they don't have the liquidity that they need. A surrender charge, it's something where if you do the proper prior planning, it should be something that is almost never applicable.
I've run into a few clients that they're on a fixed income or very low income, but yet they have $50,000 or $60,000 in annuities, but have no savings. No savings in their bank accounts, obviously they have in the annuities. is there any formula or format or guidance that we can have on the smaller clients as far as suitability, or is it just something we gotta walk away from?
You're saying if a client has $60,000 to their name, it's all they have, and it's already in an annuity?
Yes.
So the client has the money, it's already in an annuity, and your question is what?
If it's in a fixed, for example, I have one client it's in a fixed annuity, they would like to roll it over into a fixed index annuity.
Okay.
To get better growth, because it's the only money they have, and they're stuck at 1%.
Okay. So that is going to be a suitability question that is reviewed differently by each insurance company out there. I can tell you that there are some companies who would say absolutely not, even though it's already in an annuity. We're not going to take it because it's the only asset the person has. Allianz Life, for example, has a minimum of $82,000 that a client must have in liquid assets in order to be able to open up a contract. Unless they have significant monthly income, they're still working, they have a spouse who's working, and there's money coming through the door. But if you're talking about 60 grand to their name, that's all that they have, and you want to roll the money over, it doesn't matter if you wanted to roll over $1,000 of it, some insurance companies wouldn't take it. Some companies might say, well, that fixed annuity that they have right now has no surrender charge on it. It's matured. So all of that money is liquid. Yeah, they're only earning, 0.5% or 1%, but it's all liquid. The client could make the case and write a letter to the insurance company and say, with 20,000 of the 60, I want to reallocate that into a different type of annuity. I understand that I'm going to have a new surrender charge schedule on that money, but I'm going to have access to better rates, and I'm going to have some other guarantees, like guaranteed lifetime income, without annuitization that I do not have now. And they're going to review that on a case-by-case circumstance. Possible upfront additional benefits. The first one is an upfront premium bonus. A premium bonus is a percentage that is paid by the insurance company, added to the accumulation value and sometimes to the income value of the account day one when the client opens the contract. An example would be a person puts $100,000 into the contract, company ABC offers a 5% premium bonus, and that 5% bonus therefore causes the accumulation value to become $105,000 day one. Some companies have what is called a recapture schedule, which means if you were to take more than your free withdrawal of 10%, they're also going to take back a certain portion of the bonus, because the bonus in reality with some of these companies is vested over the period of the surrender charge schedule. So it might be vested over a period of 5 years or 10 years. The other thing you want to look at when you're looking at a bonus is you want to ask the question, does the bonus become vested upon death? There are some companies out there where the bonus is 10%. Client puts in 100 grand, bonus is 10%, so day one it's worth 110. Day 5, the person passes away. What happens with 110? Some companies say all 110 goes to the beneficiaries. Other companies will say, no, none of it does for the first 5 years. Some of the best accumulation products in the market right now are working in that way, where the bonus is not going to vest at all starting until year 6. Return of premium features. There are very few companies that have these, but if a client says, you know what, I love the fact that I have the safety, I love the fact that I'm going to have a better interest rate, but the liquidity is killing me. I need access. I need more access to my money. There are companies out there who will give you back 100% of your premium, sometimes within the first 5 years, sometimes for the life of the contract. However, let's just say the person invests $100,000, year one it makes $7 grand, and they want to walk away from the contract because for whatever reason they need that $100,000 back. That's fine. Most insurance carriers, however, are going to give the person back their original investment of $100,000, and they give up the interest that they earned. Some companies give a percentage of the interest that was earned in year one or in any year that they've owned the contract. So those are return of premium features. As bailout features, some carriers provide for the surrender charges to be waived in the case of certain hardships, such as a diagnosis of a terminal illness. So these are called terminal illness waivers. A person that is diagnosed as terminally ill is one who, as indicated by a member of the medical profession, will pass away within the next 12 months. You get a letter from your doctor stating that you have a terminal illness, And in a lot of cases, these carriers will waive their surrender charge, and 100% of the money can be taken in one shot. We also see this within the confinement of a nursing home. Every company has different stipulations. Most of them say that the person needs to be in the nursing home for at least 60 days. Once they are in the nursing home for 60 days, you can submit paperwork, you can activate this waiver, and again, 100% of the money within the contract becomes available. Other companies, another popular technique is not 100% becomes available, but all the money becomes available over a period as short as 5 years. We also see we also see a renewal rate or a cap rate falls below a certain level of the annuity. If that happens, then the company will say, if we lower our rates, then you have the right to get out of the product, and we're not going to charge you a surrender charge, but you're going to give up what you had for interest in year 1, 2, or 3. In summary, you can see that the FIA offers a lot of positive features: safety from the market, better growth potential, tax advantages, income guarantees, and beneficiary planning advantages, all built on the foundation of the time commitment made to the carrier. So we have those three things. We have the safety, we have the growth, and we have the time commitment. We can't have the best of all three within one program. So again, the client has to be willing to take a little bit of a step back with one of those. Chapter 6, FIA popularity. 1997, the sale was around $3 billion. Annual sales was around $3 billion for the whole FIA market. You'll see in 2009, $30 billion, 2010, $32 billion, $37 billion, and last year in 2014, we were around, I believe, $42 to $43 billion. 2015 is thought to be a $50 billion year for the FIA industry. So there's a lot of money going into this industry, and it's all for a reason. It says, losses have caused a lot of people to look for a safer place to put their money today, as well as plan for a position for themselves to be better prepared for the next market correction. So again, this is going back to the safety, growth, and control. People experienced what we saw on that chart earlier, 2000, 2001, and 2002. They experienced October of 2007 to March of 2009. We saw the 65-year-old person ready to retire, and we saw the retirement account go from $500 to $250. And now taking $25,000 a year from his $500,000 account, which is now $250, for the rest of his life is not possible. He'll outlive his money by the time he's in his late 70s. So that is the reason, those are the three major reasons for such a large and exponential increase in the amount of people and the amount of money that is going into such products. It's the safety, number one. And that is really the whole foundation. You know, we talk about foundation in terms of the time commitment, but I can tell you from experience that the foundation of the FIA, the whole allure, starts with the safety of the program, the fact that the client can't lose money. And when you couple that with the fact that you can do that while not being in a program that's only going to pay you a set interest rate, one that is set in an environment like today, where the 10-year Treasury had just dropped below 2%, it's a very attractive thing. Then you add on top of that the fact you can have guaranteed lifetime income, and you can do it without annuitizing your contract, and you can have these premium bonuses. It becomes a very attractive program. Again, going back to what this says for foundation, it has to be something that the client understands is a time commitment. An annuity is a long-term savings and income planning instrument. It is not a get-rich-quick. It is not put in $100,000, have it worth $200,000 tomorrow, and take all my money out and go do something else. It's designed to create lifetime income starting either immediately or down the road, but something that you're going to use for the long haul.
I have a quick question for that. As far as popularity, with any annuity, with a fixed index annuity or a fixed annuity, there are no administrative fees, correct? Only rider percentage fees?
Correct.
Okay, so that would be another good advantage to
Yeah.
having
Yeah.
as an add-on.
I will tell you this too. When you go into situations, again, what Susan is talking about is the fact that within FIAs there are no fees. There are no fees within an FIA unless you buy a rider, one that guarantees the income. This is something that is widely misunderstood in the industry. I was on a phone call about 2 weeks ago with a registered investment rep, and he was asking what the fees were because he was telling the client that one reason why they shouldn't buy a fixed index annuity is because the fees are exorbitant. They're through the roof, he said. And the fact is that they're zero. There is no fee at all. But a lot of people think that this cap or this spread is a fee. It's not. So you are correct, 100%. The fact that you can invest money, not have a fee, have the safety, have some growth, the guaranteed income, the bonuses, is a very attractive thing. And again, these are not designed to compete directly with mutual funds. They're not designed to compete with equities, stocks, or variable annuities. These are designed as an alternative to traditional fixed instruments, like a CD, like a money market, like a fixed annuity. That's what these are competing against in terms of the different design mechanisms. How do you get your money out? What's the interest rate that you earn? Keeping the same level of safety. That's what they're designed to compete with. FIA contract value, Chapter 7, contract provisions. So contract value. In any annuity illustration, you're going to see that it says contract value, accumulation value. What does that mean? That is the amount of money that a client puts into the contract, number one. So let's use an example of $100,000. Year one, it makes 5%. We're now at 105. 105,000 is their contract value. Maybe in year one, they receive that premium bonus of 5%. So they're at 105, and they make 5% again. They're at 110,250. 110,250 is their contract value. Any questions regarding that? It's also sometimes called an accumulation value. The annuity credits interest, typically annually on the contract anniversaries. There is an index upon which interest crediting is based, and if that index goes up, interest is credited, and once it is credited, it becomes a protected part of the contract value as well. So that is what I was mentioning earlier. Anytime that you make a gain on your anniversary date, locks in, truly becomes your new principal, therefore you cannot lose it ever. Contract values. Fixed index annuities versus variable annuities. Don't confuse an FIA with another type of annuity called a variable annuity. If someone claims to have lost money in their contract, and it's an annuity contract, there's only one type of annuity that it could be. What is it? Variable annuity. There's only three types in terms of the families. You have your fixed indexed, and your variable. And anything that is fixed, we know cannot do what? Go down. Cannot lose principal. Cannot lose because of a market decline. Annuity carriers, another element of safety is the annuity carrier. Again, you can look across the board, and with every carrier you can find what their rating is. Are they A-rated, B-rated, C-rated? What's their rating? And who are they rated by? Independent rating companies such as AM Best, Standard & Poor's, Moody's, Fitch, we analyze, as those companies, they analyze the strength, the solvency, they look at their debts, they look at their liquidity, they look at their cash flow, their revenues, their cash reserves, and they give them a rating. Does an A+ mean that they're insolvent at some point in the future? Does that mean it can't happen? No, it doesn't. Does somebody who has a C rating, does it mean they're going to become insolvent in the next year or two? It doesn't. But it's an indicator to the overall financial strength and how the balance sheet at that company looks. With an FIA, the buyer is getting contractual guarantees, and such guarantees from a strong annuity carrier give confidence that their money is safe. So yes, by design, the money is safe, but we're talking safe from market losses. You also have the risk of the company, an insolvency risk. And we always have, with any investment, what risk? Inflation. No matter where we put money, no matter where it is, we always have inflation risk. Caps and spreads, the interesting stuff. Why do we have caps and why do we have spreads? So we take 100,000, we link it to the performance of the S&P. Somebody show me with their hands. What can the S&P itself do? Right? Roller coaster. It can go up and it can go down. 66% of the time, dating back, I think, 67, 68 years, the S&P is up 66% of the time, which means it's down 34, good math. 1/3 of the time. So it's up 2/3 of the time, it's down 1/3 of the time. But we're linking to this, right? But there's no chance of loss. So how is that possible? We're doing it inside of a fixed indexed contract. So we're creating a floor of 0, absolutely 0% chance of loss. Where can you go? We've talked about this twice. Where can you go, have absolutely no chance for loss, and have all the upside of the market?
Nowhere.
Nowhere. You have to give up a little bit of something, either duration of time and the commitment, the interest rate, or the safety. So we have this floor of 0. We know we can't lose principal, what we put in or what we earn. And we know that we're tying to the performance of an index that can go up or down. So the index can go up, it can go down, but when we're doing this inside of the fixed index, we're crossing out the possibility of having any downside risk. So we're participating in only the upside, but we don't participate in all of it. Again, this is because we can't participate in all of the upside without having any of the downside. So how do we do it? How do we make it make sense? As an insurance carrier, they employ what is called either a cap or a spread. And a cap is the most that a client can earn in the contract for the contract year. So as an example, if there's a $100,000 contract and in year 1 the S&P goes up, say 10%, and the cap is 5, I say that a cap is a ceiling. It's the highest that it can go. So if the market goes up 10, you have a cap of 5, the client is going to earn 5%. You cannot earn higher than the cap. Market loses 30, what do we have happen? The 0 is your hero effect, client doesn't earn anything, and we stay at 105,000. What is a spread? A spread is what I call a haircut. It's the amount that comes off the top. And this is what registered investment advisors and brokers often confuse as a fee. They think that a client is paying this. It's not. It is a haircut. It is an amount of interest that comes off the top of the interest that the index has earned to determine what is called your credited interest rate. The credited interest rate is the amount that is credited to the client's contract. So again, if the market goes up 10% and the spread, let's use one that's happening right now, 3%, that is the amount that comes off the top. It's 10% minus the 3% spread. The client will earn 7. What happens if the market goes up 20 and the spread's 3%? Client gets 17. So there's definitely a reason why a spread is more attractive than a cap, especially in today's environment. Now, the question I get is, well, Jack, isn't that a fee? It's not, because it's not an amount of interest that's coming off your accumulation value. You guys need to understand that a fee is an amount of money that is applicable in the form of a charge to the amount of assets under management, regardless of performance. So if you have 100,000 and in year 1 the contract earns 0.00 and there is a overall 2% fee, there is going to be 2% less at the end of the year, 98 grand. In an FIA, if the market goes down 30%, there is no 3% or 4% spread to take off the top, because there is no top, we're down here. You're still going to stay at 100 grand. There's no 3% spread to take. It's a haircut off the top of the interest that was earned by the index. Earned. If there's a losing year, there's no spread to take. So don't let anybody ever convince you that these are fees, because they're not. A fee is an amount that is charged every single year on the accumulation value. It is not an interest rate that comes off the top of the index earnings. Okay? Because there are professionals out there who have been in the business for 20 years on the variable side that don't know this. And they will tell your clients this face to face. Okay? So it's important you guys understand that. There is no fee inside of an FIA unless you're talking about a rider or unless you're talking about a surrender charge. Period. No fees.
Quick question on the spread. If you have a 2.5% spread and the market does 1.5, do you get to keep 1.5%?
Well, let's do the math. Market goes up 1.5. We got to take away what? 2.5? So what? We're at -1, right? So the overall is -1, so we get a 0. 0 is our hero. That's right. Okay? Whatever the rate is, subtract the spread. If it's ever below 0, you get a 0. If it's ever above 0, that's what you get. Says here too, last paragraph, page 20, keep in mind that fixed index annuities are not designed nor are they intended to replicate stock market returns. They are they are more comparable to safer, more conservative financial vehicles such as bonds, CDs, and money market instruments. They are designed to offer consumers guarantees of principal, yet also the possibility of higher interest rates. So when you're in the home, don't ever talk about taking money out of stocks or mutual funds and say that the reason why we're going to do this is try to get a better rate of return than what you're currently doing. Wrong answer, 100% wrong. And you're also going to put yourself in hot water with regulatory rules. Okay, taxation of annuities. We've been through this as well, right? Qualified versus non-qualified. What is an example? Somebody give me 3 examples of a qualified account. 401k, 403b, SEP, SEP IRA, traditional IRA. These are all qualified plans. When we put money into a qualified plan, except for a Roth, what are we doing when we put the money in that year?
Deferring tax.
We're deferring tax, but what is the first thing we're doing? You take $5,000 and put it into your IRA. You go fill out your 1040. You go fill out your 1040, and that $5,000 is what?
Off the top.
It's a deduction. You're deducting that $5,000, so you're not paying taxes on that $5,000. Then what happens, Chris? Tax deferral, as you just mentioned. That $5,000 is now growing tax deferred. So at some point in the future, we know that the money we originally put in, plus all the interest earnings that it has, have never what? Have never had taxes paid on it. So 100% of that money that comes out is going to be taxable at ordinary income tax rates. Why? Because it's an IRA. It's a qualified plan. Okay? Non-qualified accounts. What's going on with a non-qualified account? We're establishing what? Cost basis. What comes into effect? Last in, first out. LIFO. We're learning, aren't we? Let's give ourselves a round of applause. We're learning. LIFO. So we establish a cost basis. That is the amount of money we put in. We've already paid taxes on it. It's just like a Roth IRA. However, a Roth is a qualified plan. We put $5,000 into a Roth. Are we deducting it in the year that we put it in? No, we're not. We're paying taxes on it. But the gains every single year are tax deferred, and the money later on is tax free. That is only with a Roth. What's that?
That's why they put a limit on what you can actually put into it.
It's one of the reasons, absolutely. Yep. Largest one, probably. Yep. On the non-qualified annuity, you're doing the exact same thing in terms of putting money into a contract that you've already paid taxes on. However, the only difference is that, yes, it's going to grow tax deferred, but when you take the money out, it's not all tax-free. The gain is all taxable. LIFO, L-I-F-O, last in, first out. The last to go in is the interest, the first to come out is the interest. Okay? So qualified versus non-qualified, that covers it. Any questions on qualified? Anybody have questions regarding what examples there would be of qualified or non-qualified taxation? The last thing to know is that an annuity, if it is non-qualified, the gain is the only part that's taxable, and it's always taxable at ordinary income tax rates. If you live in Florida, you don't pay state tax. If you live in Maine, you pay federal and you pay state. Beautiful. Okay, chapter 10. We're cruising along. Chapter 10, estate provisions. Again, this goes back to 2 things. What are they? What are the advantages of the estate part of an annuity? The probate. What can we do? We can avoid it by doing what?
Listing beneficiaries.
Beneficiaries, they need to be individuals, not your estate. And when we list individuals as beneficiaries, the 2 things that we're doing is we're controlling the speed, number 1, at which our beneficiaries receive the money, and we're controlling the level of privacy of the money. So speed and privacy, I'd lock those 2 terms in your brain when you're talking to a client.
And you said that it passes tax-free until they spend it, right? So it's like life insurance?
Well, again, it depends on the type of contract that you're passing.
I'm sorry, I meant non-qualified.
Non-qualified. So if it's a non-qualified account and the beneficiary decides that they want to take that money elsewhere and say go invest it in mutual funds because they're younger and they want to be more aggressive, they're going to take all the money out, they're going to pay taxes on all of the gain.
But actually transferring the money to them, they don't have to pay any sort of estate inheritance tax or anything like that.
Inheritance tax is going to be based on the size of the estate of the person who passed. So, yeah, so I mean, here in Maine, it's $2 million. On a federal level, it's over $5 million. So if the person who owned the annuity that passed had an estate that was over one of those levels, they would pay either state or federal state taxes at whatever rate it is at that time. If you're talking about just income tax, let's say that Joe passes away. Joe owns an annuity, and he passes that to his granddaughter. The taxation is going to depend on what she decides to do with it. If she leaves it right there and makes it her own and keeps it as an annuity, then there is not going to be a taxation. If she 1035s the money somewhere else, because now she's the owner of that contract at the same company Joe opened the contract, and she decides to move it to company XYZ and doesn't want to pay the tax, she can do a 1035 exchange. If she says, I'm getting out of annuities and going into stocks, bonds, mutual funds, some other type of investment, she's going to have to get out of the annuity and she's going to have to pay the tax on a non-qualified.
But not only is she gonna have to pay the tax on the gains, but she's also gonna have to claim what she receives as income on her income tax, correct?
No, because if it's well, you're talking about the original 100,000 too? Yeah. No, because it's not income. It's a passing of money. It's a gift. The 100,000 has already had taxes paid on it. The gain, she will. It's like having $100,000 in a CD. Person puts it in, day 2 they pass away, it goes to their son, there's no taxes to be paid. It's like a checking account. All right, chapter 11, we're getting there. We only have 2 more pages to go. Chapter 11, benefits and limitations of fixed index annuities. So here's some of the critiques that we hear in the industry. They are complex. Are they? Depends how much time you've spent reading up on annuities. It depends how much time you spend trying to understand. Sellers earn high commissions. So we're going to talk about all these. Surrender charges are too long. What is too long? They don't credit all of the index gains. We just went over that. Caps, spreads. They aren't FDIC insured. Those are some of the downfalls that we hear. They are complex. Are they complex? Yeah, I would agree that they are. If you are a person who does not work in the insurance industry, and you are said, here's a package of information, here's the product brochure, and here's the statement of understanding. I want you to read this and figure it out with no background at all. It's a lot to take in, which is why we are all here doing what we're doing and advising clients. Do we earn high commissions? Well, number one, it depends on a lot of things. It depends on what you, number one, consider high. I say that we're paid fairly, but we are paid based on the amount of money that goes in. We are paid on based on the age of the client. We are paid based on the surrender charge schedule and the number of years that they choose for a product. If a client is 80 years old, I can tell you that commission is sometimes 25% of what it would be for a 50-year-old. So there are some cases where we are paid, I think, too little. Otherwise, I think we are paid fairly for what we do. We are paid based on the value that you supply to a person. Surrender charges are too long. That is an individual circumstance. Again, surrender charge schedules, they should never be a problem if you're doing your job and you're doing proper planning. If the surrender charge schedule never comes into play because you reserve enough assets for everything else that they need, then what does the surrender charge schedule matter? If it doesn't, especially at death if it goes away. And if they're using this again and they understand from the very get-go that this is for long-term income purposes, the surrender charge schedule is not as applicable. But it's something that you absolutely need to disclose. It's something that you need to fully educate the consumer on, and you need to make sure that they understand why you're recommending the amount of money you're recommending to put into one of these contracts, with part of your reasoning being the surrender charge schedule. They don't credit all of the index gains. Is that a bad thing?
I don't think so.
It's not.
Protecting your
It's
downside.
exactly right, Chris. It's the trade-off. Is it a bad thing? Well, here's the flip side. If you get all of the upside of the market, you also have to take what?
All the downside.
All the downside. So to me, people say, well, you don't get all of the gains. No kidding. We're doing that on purpose. We are making a floor of 0 our floor, right? Okay. They aren't FDIC insured. No, they're not. Guess what? Your money at the credit union is not either. It has its own form of protection. So does the insurance industry. So does the security industry. It's just not called FDIC. And you know what? Personally, I would much rather have, rather than a promise that we're going to levy tax dollars, I'd rather have an association that actually has the cash sitting there ready to go to pay my claim. Personal preference. Anybody with me? Okay. Let's see, next, benefit to owners. We just went through some of the criticisms. Here are some of the benefits. Safety of principal, we've been through that. Potential to earn a respectable interest rate. You're going to see interest rates anywhere between 0 and some positive number, depending on the company you go with, whether it's a cap, whether it's a spread, a participation rate. I will tell you this, use companies who publish renewal histories. Don't go with a company who is a fly-by-night company. They might be A-rated, but they are known for issuing a cap originally at 7, and then within 3 years of the client owning the contract, their spread is down to 4%. We see that with carriers all the time. And there are some companies out there, if you want to know who they are, feel free to ask me later, but there are plenty of companies out there who will publish their renewal history and say, what you buy is what you're going to own. You're going to buy a program with a 3% spread. You can pretty much plan on having a 3% spread for the life of that contract or within 5 to 10% of that. That's a big deal. Because if you're going to buy a contract with a 3% spread, and I showed you the same one sitting right beside it, and it was a 6% spread, which one are you going to buy?
3.
The 3% spread. Well, what if that 3% spread can become the 6% spread with that company? That's what you bought. So you need to buy the company that you know is going to keep their caps and their spreads in the ballpark of what they issue. The opportunity to earn and have a stable stream of income. 2 major concerns of retirees today is having their income outlived and also having something health-wise occur to them that forces them unwillingly to have to spend down the assets they've worked their entire life for to pay for their care. So lifetime income is extremely important. What about complexity? Like most financial products, all FIAs differ slightly in terms of certain provisions, riders, etc., and these differences provide options for consumers to match the annuity to their specific situation. We are all independent, which means we can use any company that we want. You need to do your homework. You need to make sure that the company that you're using is tailored to your client, meaning the company and the product. There are hundreds of companies, excuse me, and there are hundreds of products. You literally have the ability to tailor a product to a client's needs. So if you have that ability, my recommendation is that you spend the time to figure out what program actually does that. Do agents and brokers get paid high commissions? We've already discussed that. Again, it really is based on, what's your definition of too high? And we are paid all over the board from, X% to Y%, depending on how much money is invested, what is the duration of the contract, what is the person's age. And you need to remember, too, that we are not, on these annuities, we are not getting paid 2% or 3% every single year, or 1% or 1.5% every single year. We are getting paid up front to service this contract for the life of the contract. And one thing I can tell you too many agents and brokers do is they sell a contract, they get paid their commission, and they're right off to do what? Find the next one. And they forget about Joe and Sally, who they just sold, who they made a promise to, oh, I'm going to be your guy, and I'm going to be here for the next 10, 15 years, and I'm going to service you with everything that you need. You need to make sure that whatever you tell that client you're going to do in that situation is what you're going to do. You are paid handsomely for what you do to manage and service the contract for the life of it. Okay?
Give me an example, Jack. I gotta play that game out. When you sell an FIA like that, what type of service are you going to be giving a client who has a 10-year surrender fee?
Yeah. So this is like David Stearns from Dale Carnegie was talking about earlier. A client calls you. They have a question about their contract. You call them back the same day. Make yourself a 24-hour rule. make sure they're at least called back within 24 hours. Don't be the guy who only calls, or the woman who only calls to check in on the anniversary. A lot of people skip the anniversary date and say, oh, no changes are necessary, I don't need to call. Make sure you call. Make sure you implement a system where you're doing things that your competition is not. One of the things that I do is I find out when I meet a person, if it's a married couple, I find out their anniversary date. And what I'll do, this is a great little trick of the trade that I learned, I will call the husband a day before, and I'll say, hey John, I just want to remind you that tomorrow's your anniversary with your wife. He's like, wow, how did he remember that? You can put that into a system. Birthday cards, Christmas cards, Thanksgiving cards, just because notes, handwritten notes go a long way. I have a rule minimum of twice per year, so 6 months just to check in. Anniversary date, Kevin does the exact same thing. When you have an anniversary statement, don't just call up your client and say, no changes are needed for the year, I just wanted to let you know we're all set. Go through what the program actually did. These people are going about their lives every single day. They think about this probably 1 or 2 days per year. They forget what they have. They forget how it functions. Use that time to let people know that this is what you purchased, here's why you purchased it, here are all the benefits that you have, and I want to remind you that you have access to A, B, and C as well within this program. This is also how you're going to build a referral business. So you need to use these opportunities of timing to get back in touch with the people that you've already met with. You are paid to service it for the life of the contract, so do that. Actually service it. Actively service it. Surrender charges. Why are there surrender charges? Pretty simple. You give a company $100,000, they pay Darren his commission, they go out and they buy bonds to make sure you can participate in the upside of the market along with the option contracts. They pay all the administration to print the contract, run all the business they need to run, and get that contract out the door. They have thousands and thousands of dollars invested immediately. Do they need time to earn that money back and create corporate profits? Absolutely. So a surrender charge schedule makes sure, too, that if they give you a bonus of 5%, that there is something stopping you from taking that now $105,000 value and going over to the next company and getting your 10% bonus and the next company getting another 10% bonus, right? Okay, that would be something. We'd be very popular. Yes. Why don't fixed index annuities credit all the index gain? We already went through that. That is because of the fact that we installed this floor and there is no product out there or investment where you can have zero downside and all of the upside. So we are going to have either a cap, a spread, or a participation rate. And I can tell you right now, look to spreads. They're highly valuable. I had a couple of clients in the past couple of weeks, 10% rates of return. 3 of them last week, 10% rates of return. Average is 9.8. In an FIA, where that's now their new principal, they can never lose it, and it's invested in a way where it's also going to determine the guaranteed lifetime income that they receive for the rest of their life. The client that's getting $1,000 a month that has a 10% gain is now getting $1,100 per month. 10% increase. What's the COLA this year for Social Security? Does anybody know? It's 1.7. It's 1.7. So having the ability to have these types of gains in a contract is awesome. It really is. And yes, we are capping. Yes, we are spreading. Yes, we are adding a participation rate to what you get, but we're also taking anything below zero and taking it out of the picture. That's why we do it. To me, that's not a problem. It's a good thing. Why aren't they FDIC insured? It's governed by the state of Maine. It's an insurance contract, therefore it's governed by insurance regulators. We have our own type. Again, Maine State Annuity Guarantee Association, $250,000 per member, per owner for each company. Okay? Per member, per owner contract. Again, page 24, it states that NOLHGA, Gilman, give me that in military terms. Nancy.
November,
Oscar,
Lima,
Hotel, Golf,
Alpha,
Alpha.com. That's right. This is where you can go to get information regarding what the rates are. in terms of guarantee levels through the State Guarantee Association. Okay? 9 answers every investor needs to know. In the back of your packet, we have information regarding what types of returns can we expect from an annuity. Well, first of all, it depends on, is it a fixed index, or a variable? Is it true that index annuities can limit how much interest I earn? Yes, it is. There's a reason for it. Make sure you understand why. Okay, so please explain about the kinds of expenses associated with the annuity. Don't let anybody tell you that a FIA has a fee, because it doesn't. The rider has a fee. Do variable have fees? Yes, they do. Every single one of them. Mortality and expense fees, administration fees, management fees, they have those. Fixed annuities, meaning your traditional fixed, your MIGAs, do they have fees? Usually not. Unless you're talking about surrender fees. Okay? But again, you need to take out more than 10% of your contract in any 1 year. If the free withdrawal is 10%, you need to take out more than that amount to have a fee. Can you explain why there are surrender charges? We have answers to that question. Make sure you're able to explain why a contract has a surrender charge. Is it true that many income riders are beneficial only if the annuity performs poorly, and that they require turning my annuity into a stream of income payments? Is that true? The answers are in here. I've heard that annuities pay high commissions. We've gone through that. Here's some more answers, some more information you guys can use. I've heard that FINRA and the SEC have reported that there are a lot of consumer complaints with annuities, and that the insurance companies reserve the right to change the terms of the contract. Make sure that your clients read the Statement of Understanding. The Statement of Understanding will say what is guaranteed in the contract, what can change, and why those things that can change, why they can change. So you need to know what are the moving parts within the annuity that you're selling. Do I pay extra for tax-deferred status of an annuity, and what happens when I die? Do we pay extra fees for tax-deferred? No, they all are. All annuities are tax-deferred. What happens when you die depends on how you list your beneficiaries. We've discussed that. How does inflation impact my annuity income, and are there ways I can address it? What is the one thing I said is always in effect? Inflation risk. It's always in effect, no matter where you invest money. And then finally, we have a National Association of Insurance Carriers Buyer's Guide. So I suggest that when you are meeting with a consumer, always leave behind with them the product brochure of the specific product you're recommending, a statement of understanding or the disclosure form for that specific annuity, and the State Buyer's Guide, National Association of Insurance Carriers. It's a third-party, non-biased overlook about annuities, what they are, and what a consumer needs to think about before they purchase one. Make sure that your consumers are doing their homework so that when you go back to close the deal, you know that they know what they're buying. What we did here today was 101. This was the bare bone basics. Next time we're going to get a little bit more specific in terms of how do these caps and spreads work. What are they currently in the industry? What are the actual rates? What are some products that we should be looking at that are using spreads? Again, we talked about spreads and the value of those today over a cap. We're going to talk more specifically about how these income riders work, how they generate the income, what type of income, meaning what amount are you able to create with certain dollar values. We're going to talk more about case studies in the future. We're going to talk about here is a client, here's their income, here are their expenses, here's what they have for Social Security, here's what they do or do not have for a pension, and we want to figure out where does the annuity, if at all, where does it fit? And then from there, how do we introduce it to the client? How do we overcome objections? So we're going to talk about objections as well. So how do we go from understanding the basics of an annuity, which is your job to also relay that message to the consumer, how do we go from there to actually talking about a specific product and then looking at a fact finder that you've taken in the meeting and understanding where they fit and what's the right type and what's the right amount? And how do we match that up with creating the income that they need, the level of safety that they need? How do we look at the performance of other accounts that they currently have to say, you know, you've been currently getting 1% or 2% or 3%, and I think that we may be able to do a little better over here in this type of annuity. Here's why. How do we go about that? How do we explain the safety? How do we explain the objection about FDIC insurance that we talked about in here? How do we properly, I should say, how do we properly explain the State Guarantee Association. Go sell.